Trend lines, powerful, easy-to-use indicators. Trend is about the direction in which a stock price is moving. While stock prices fluctuate up and down, they often have a general direction, either upwards, downwards or sideways. Often, we can draw straight lines on a stock chart to give us a clearer picture of where a stock has been, and we can project where it might be going. These lines are known as trend lines. Though not considered to be technical indicators, as are mathematically derived indicators such as the Relative Strength Index, RSI, or the Moving Average Convergence, Divergence, MACD indicators. Yet, they can reveal a lot about a stock's price. Keep watching to learn more about trend lines, but first, please take a moment to like our video and subscribe to our channel. Typically, lines are drawn on daily closing prices on stock charts. Although stocks usually oscillate up and down, having troughs and peaks along the way, they may have an overall directional trend. An uptrend is when a stock's price shows successively higher highs and higher lows. Each time the stock goes high, it reaches a price higher than the previous time, and when it dips, it does not drop as low as the last time. A downtrend, of course, is the opposite, namely a series of successively lower lows and lower highs. You don't have to be a genius to draw trend lines, and they are easy to interpret as to how a stock price might move in the short term. To draw a trend line for an uptrend, draw a line that touches two or more of the lowest price points on a chart. Extend the line to the right, into the future. The theory is that when the stock price falls below this trend line, the trend is probably reversing, and the upward trend may be nearing the end of its run, at least for now. To draw a trend line for a downtrending stock, draw a line that touches two or more of the highest points on a chart. Extend the line to the right. A trend reversal is signaled by the stock price rising above this line. Naturally, it only takes 2 points to draw a straight line. The more peaks, or dips, that touch a trend line, the more credibility it has in defining the trend. Also, the longer the period of time the trend has continued, the more reliable the continuation. The best way to detect a bullish trend is to look for a series of higher highs and higher lows. In other words, each time the stock goes up, it goes up a little further than before. As it retraces back down, each time it will not go down as far as it did the last time. When parallel trend lines can be drawn across the peaks and troughs of a stock, creating what is referred to as a channel, a special case is presented. These parallel lines can be horizontal or can tilt upward or downward. Extending these parallel lines creates a bottom price area, a floor, or support level, and a top price area, a ceiling, or resistance level. If a stock breaks above a resistance level or below a support level, it is often an indication that the stock may be breaking out of that pattern and will continue to move in that direction. If this happens on heavy trading volume, that helps confirm a new trend, indicating there is pressure to force the new direction to continue. Trend lines help traders decide whether they should buy or sell a stock, depending on the direction of the trend. Horizontal parallel lines can indicate a trading range for sideways moving stocks. As stocks bounce between support and resistance levels, swing traders take advantage of this sideways trend by buying at the low support area and then selling at the top resistance level. They can also do the opposite, and short a stock when it's at resistance and buy it back when it falls to support. When a stock breaks out and goes above a resistance level, or breaks down below a support level, a trend in that direction may be forming. Use other technical indicators to determine the strength of this breakout, such as trading volume. Option traders can do similar trades to take advantage of range-bound stocks. By using bull-put credit spreads, bear-call credit spreads, and short iron condors, options traders can take advantage of these price swings. At the time we created this video, the Russell 2000 Index, ticker symbol IWM, has been in a trading range for several months, and we have used these option strategies to make money while it has been in this trading range. Traditional long-term, buy-and-hold, investors miss out on all of these great money-making opportunities. Support and resistance price levels are formed by the opinions of the crowd. When a stock price hits a ceiling, a resistance price, this means buyers are exhausted, and can't push the stock any higher. They don't think the stock is worth more than that price. Traders either begin to take profits or bail out of their stock positions, and the stock makes a reversal. It falls until the fear that traders had is gone. This support level prevents the price from any further downward movement, and as optimism returns, the price heads back up. Once again, the bulls are stopped by the bears at the upper resistance level, and the stock begins to retrace downward. The trading in this range can last for quite a while, and act as a time of rest or consolidation before a breakout occurs, when the stock is ready to make a major move. The main drawback to trendlines is that sometimes drawing trendlines can be somewhat subjective, especially if a stock is not trending in a clear direction. Practice drawing trendlines. Experience will help you better draw trendlines and interpret them. Trendlines can tell us a lot. Used in conjunction with volume and other technical indicators such as money flow and candlestick charts, they will guide you in projecting the short-term move of a stock. Happy trading!